Ladies and gentlemen, today's financial alert is one the world cannot afford to ignore. The gold-silver ratio, a benchmark that has guided investors, economists, and market historians for centuries, has collapsed to an astonishing 15:1. This is not just another number. This is a signal, a warning, a flashing red light for 2025. To understand the gravity of this moment, we must look at what the ratio truly represents. For decades, the gold-silver ratio hovered between 61 and 81. Even during market stress, it rarely broke below 41. A move to 15:1 is nothing short of historic, a level we've only seen during periods of monetary resets, currency failures, or major global economic turning points. So what does this mean? It means silver is drastically outperforming gold, but not because gold is weak. Gold is rising, but silver is exploding. A ratio like 15:1 tells us that silver demand is outpacing supply in ways the market can no longer hide. Industrial consumption is surging. Solar, EVs, cybersecurity, AI infrastructure, all consuming massive amounts of silver at a speed global mines simply cannot match. The collapse of the gold-silver ratio to 15:1 is not just a financial statistic or a market anomaly. It is a once-in-a-lifetime signal that the global economy is undergoing a shift so profound that most people will only understand it in hindsight. For years, the precious metals market has operated within a predictable framework. A ratio between 61 and 81 was considered normal, healthy, and consistent with the patterns observed throughout modern financial history. Even during panic periods, recessions, market crashes, inflation waves, the ratio rarely fell below 40%, 1%. That stability allowed analysts, investors, and traders to gauge the relative strength of gold and silver, using the ratio as a compass to understand market sentiment and systemic pressure. But now, with the ratio collapsing to 15:1, the old compass is useless. This ratio belongs to another era, an era where the global monetary system is under so much stress that precious metals begin behaving not as investments but as lifeboats. When the gold-silver ratio collapses to such an extreme, it usually means one thing: silver is outperforming gold with a force that cannot be explained by normal market behavior. It means silver demand has gone so far beyond supply that the price has transitioned from gradual movement to aggressive repricing. And this repricing doesn't happen quietly. It happens explosively. To understand the magnitude of this collapse, one must remember that gold and silver usually move in the same direction. They're both monetary metals. They both react to inflation, interest rates, currency weakness, and global instability. But silver is different in one critical way. Silver is simultaneously a precious metal and an industrial metal. It is essential in solar panels, electric vehicles, medical equipment, artificial intelligence hardware, robotics, communications infrastructure, and energy storage. Silver is consumed, not just stored. Unlike gold, which almost always comes back to the market eventually, much of the silver used in industry is never recovered. It is locked inside products, landfills, or micro-components too small to extract. This is why a collapse to 15:1 is so alarming. It signals that industrial demand has overwhelmed global supply, and investment demand has added fuel to the fire. It signals that the mining sector cannot produce enough silver quickly enough to meet the world's needs. The majority of the world's silver mines are aging, production costs are rising, and most silver is produced as a byproduct of other metals like copper and zinc, which means miners cannot simply increase silver output even if prices skyrocket. A ratio this extreme tells us the market can no longer hide the imbalance. It tells us that buyers are rushing into silver not because they want to diversify, but because they feel they must. In financial history, every time the ratio approaches extreme levels, it marks a turning point. It reflects fear of currency devaluation, fear of economic instability, and fear of paper assets losing credibility. And yet, it also reflects opportunity, because when ratios collapse this fast and this hard, it means the world is repositioning itself. It means the global financial system is signaling that the old valuations of precious metals are no longer valid. A 15% one ratio is more than a number. It is a warning. It is a message from the market that something big is unfolding beneath the surface, and those who pay attention now will be the ones who understand the financial landscape of 2025 before everyone else wakes up to it. Silver strongly outperforming gold during a moment like this is not a small development. It is a seismic shift that tells us the entire structure of the global metals market is changing right in front of our eyes. Gold rising is normal during uncertainty, but silver rising faster, so fast that the gold-silver ratio collapses toward 15:1, means something far deeper is happening underneath the surface. It means silver has entered a phase where its value is no longer being dictated by traditional investor psychology, but by raw supply and demand pressure, industrial urgency, and monetary distrust within the global financial system. This outperformance is not a bubble, not hype, and not a temporary spike. It is an economic pressure point that reveals how strained the world's resource system has become. When silver outperforms gold this aggressively, it signals that the market sees silver as having far more room to grow. While gold is largely used for wealth preservation, silver has a dual identity, and that dual identity is the real engine behind its extraordinary strength. Silver is simultaneously a safe haven asset and a critical industrial resource. Gold may shine in a crisis, but silver becomes indispensable to technology, infrastructure, and the energy transition, things the modern world cannot function without. This gives silver the ability to outperform gold in ways that feel exponential rather than incremental. The more industries rely on silver, the more its price disconnects from gold and begins forging its own independent trajectory. This outperformance becomes even more dramatic when investment demand spikes at the same time industrial demand surges. Over the past decade, retail investors and institutions have slowly been awakening to the reality that silver has been suppressed, undervalued, and structurally misunderstood for years. When they see gold rising, they buy gold. But when they see silver rising faster, 3, 4, even 5 times faster, something shifts. They begin reallocating from gold to silver, accelerating silver's momentum while easing pressure on gold. This shift becomes a feedback loop. Rising silver attracts more of the kind of investment that pushes it even higher. And because the silver market is much smaller and more thinly supplied than gold, every dollar that enters silver has a greater impact on price. But the outperformance is not just about demand rising, it's also about trust falling. Trust in currencies, trust in debt markets, trust in central banks, trust in paper-based financial systems. All of these factors influence gold. But silver adds an extra layer. It reflects distrust and scarcity simultaneously. Investors may buy gold to protect wealth, but they buy silver when they believe the system is under real strain. Silver is a fear and function metal. It surges when investors fear inflation, currency erosion, or economic instability. But it also surges when industries cannot operate without it. Another major reason silver outperforms gold is because silver has a natural explosive nature in bull markets. Historically, whenever both metals rise, silver tends to multiply gold's performance. Silver is cheaper, more volatile, and more sensitive to monetary stimulus and industrial cycles. When the market tilts even slightly in its favor, silver reacts violently. A small shift in demand can create a massive shift in price because silver supply is extremely limited, poorly scalable, and declining in many regions. Gold mines can scale faster than silver mines, but silver mines are often secondary producers dependent on other metal markets. That means silver cannot simply respond to higher prices with higher output. The scarcity intensifies the price movement. When silver outperforms gold at this scale, it's a message from the market that a deep imbalance is unfolding. It says the world is waking up to silver's true value and that gold can no longer dominate the conversation alone. The outperformance is not the end of a trend. It's the beginning of a revaluation that will define 2025 and beyond. Industrial demand for silver is exploding in a way the world has never seen before, and this surge is now one of the most powerful forces driving the precious metal into an entirely new price era. Silver has always been known as a monetary metal, but in today's world, it is transformed into something far more critical, an industrial backbone of modern civilization. Every major breakthrough, every new technology, every energy transition plan, and every futuristic innovation depends on one resource more than any other: silver. This dependence has pushed demand to levels that global supply simply cannot keep up with, and that imbalance is becoming more obvious with every passing year. The largest force behind this explosion in industrial demand is the global shift toward renewable energy and electrification. Solar energy alone is rewriting the future of silver. Every solar panel requires silver for its conductive properties, and as nations race to meet carbon neutral goals, the number of panels being installed is rising exponentially. Countries like China, the US, India, and many across Europe are aggressively expanding solar infrastructure, and the demand curve is becoming vertical. Silver is the heartbeat of solar power. It is irreplaceable, unmatched, and without it, solar cells cannot function. Even small increases in solar production magnify silver consumption on a massive scale. As the world pushes toward cleaner energy, silver consumption is accelerating faster than mines can supply, creating a relentless upward pull on demand. Electric vehicles are another explosive catalyst. Every EV requires significantly more silver than a traditional gasoline vehicle. From batteries to onboard electronics to power inverters, silver's conductivity makes it indispensable. The global automotive industry is shifting toward all-electric production, and this transition is only in its early stages. As EV adoption rises, silver demand grows automatically and indefinitely. And unlike other metals that have substitutes or alternatives, silver has no equal in conductivity. This positions silver as a non-negotiable resource for the future of transportation. But the story doesn't end with solar and EVs. Silver is now embedded in nearly every major technological advancement. The rise of artificial intelligence requires vast amounts of computing power, processing units, and communication systems, all of which rely on silver for optimal conductivity. Data centers, AI servers, 5G towers, robotics, medical devices, satellite system, and cybersecurity hardware all consume silver at a rate that simply did not exist a decade ago. The digital world has become silver hungry, and the pace is accelerating, not slowing. Even small industries collectively add enormous pressure to silver demand. Hospitals rely on silver for antibacterial applications, water purification systems need it for filtration. Semiconductor manufacturers use it in production processes. Smart appliances, renewable grids, LED lighting, military technology, telecommunications, and aerospace all require silver in some form, and none of these sectors are shrinking. Each year, more devices become electrified, more components become digitized, and more systems become automated. And with every step forward, silver becomes even more critical. The challenge is that while demand skyrockets, supply cannot respond. Silver is not mined primarily on its own. It is mostly a byproduct of base metals like copper, zinc, and lead. This means even if silver prices triple or quadruple, miners cannot dramatically increase output unless base metal demand also increases. This structural limitation ensures that industrial demand will always have an advantage over supply. When demand expands and supply remains restricted, the result is predictable. Price pressure intensifies, shortages emerge, and competition for available silver becomes fierce. The explosion of industrial demand is not a temporary phase. It is the new foundation of the global economy. Silver is no longer just a metal. It is the bloodline of modern technology and the energy transition. And as the world becomes more advanced, its dependence on silver will only deepen. This is why industrial demand is now one of the most powerful forces shaping the metal's future, and why its impact on prices in 2025 and beyond will be impossible to ignore. Silver becoming critically scarce is one of the most serious and least understood developments in global markets today. Many people still imagine silver as an abundant metal, something easily mined, cheaply purchased, and readily available whenever demand rises. But the truth is the complete opposite. Silver is entering a period of structural scarcity unlike anything we've seen in modern financial history, and this scarcity is now emerging as one of the driving forces behind its dramatic rise. The world is using silver faster than it can be mined, and this imbalance is growing larger every year. What makes the situation even more alarming is that most of the world still has no idea how low silver inventories have fallen and how tight the supply chain has become. Silver scarcity is being shaped by three unavoidable realities. First, global mining output has been stagnating and in some regions declining. Most of the world's major silver mines are aging, and new high-grade deposits are not being discovered at a pace that could solve the shortage. Silver is not like copper or iron, where large new deposits are regularly found. It is geologically rare, and the easily accessible sources have already been heavily mined. The deeper and more complex the remaining deposits become, the more expensive and challenging the extraction process is. As a result, miners are struggling to keep production levels stable, let alone increase them in the face of soaring demand. The second reality is that most silver is not mined as a primary metal. Around 70% of global silver supply comes as a byproduct of mining other metals such as copper, lead, and zinc. This means silver output cannot easily respond to rising prices because miners do not control silver production directly. If demand for copper goes down, silver supply automatically falls, even if the price of silver is rising. This structural dependency makes silver incredibly vulnerable. Lead to supply disruptions, and it also guarantees that supply will remain tight, regardless of how high the price goes. No amount of investment speculation can magically increase silver production. The geological and industrial limitations simply won't allow it. The third and most devastating reality is that silver demand, especially industrial demand, destroys more silver than it returns. Unlike gold, which is almost entirely preserved and can be melted and reused endlessly, most industrial silver ends up in landfills, tiny electronic components, discarded technology, and non-recoverable applications. Recycling silver is extremely difficult, often too costly, and in many cases, physically impossible. Once silver is embedded into certain technologies, it is gone forever. The world extracts millions of ounces of silver from the ground, but only a fraction ever returns to the market. This long-term depletion is pushing the metal into an irreversible scarcity trend. Inventories reflect this crisis clearly. Major silver vaults, ETFs, and exchange warehouses have been reporting consistent drawdowns year after year. Physical silver is leaving the system faster than it is entering it. Industrial buyers, refiners, and investors are all competing for the same shrinking pool of available silver. In some cases, premiums on physical silver have surged even when spot prices have not, revealing the true tightness of the market. Dealers struggle to maintain stock. Delivery times increase. Refiners face shortages. Mining companies warn about limited future output. These signals are not temporary, they are the early stages of a long-term supply crunch. This scarcity also has psychological and financial consequences. When an asset becomes rare, people instinctively begin to value it more highly. When investors realize the world is running out of something essential, demand accelerates even further. Scarcity triggers fear, and fear triggers buying. And in the case of silver, every new surge of buying pressure intensifies the shortage because there simply isn't enough metal to satisfy everyone. Silver's scarcity is not a distant risk or a theoretical scenario. It is a present, unfolding reality. The world is waking up to the fact that the metal it depends on for energy, technology, industry, and economic protection is becoming harder to obtain. As this scarcity deepens, the value of silver will not just rise, it will be fundamentally redefined. A gold-silver ratio collapsing to extreme levels is more than a shift in metal pricing. It is a signal that the global financial system is under deep structural strain. Markets don't move violently without a reason, and ratios that have stayed stable for decades do not suddenly shatter unless something is seriously wrong beneath the surface. When the ratio falls toward 15, it reveals that trust in the financial system is weakening, and that investors are scrambling toward assets that cannot be printed, manipulated, or inflated away. Such a collapse has historically accompanied major transitions, crises, and resets, and the message it sends today is no different. Stress inside the global economy is building to a point where traditional financial tools are losing their power. A collapsing ratio suggests that the world no longer sees paper promises and fiat currencies as stable stores of value. When people start doubting the reliability of central banks, governments, and financial institutions, they shift their wealth into hard assets. Gold usually leads this move, but when silver begins outperforming gold so dramatically, it means the panic has reached another level. Investors are not just seeking safety, they are seeking leverage against systemic failure. Silver, with its historical tendency to rise fast, during periods of instability, becomes the asset of choice for those who believe the system is more fragile than it looks. This loss of trust is not sudden. It has been building for years. Massive government debt, relentless money printing, rising inflation, geopolitical tensions, collapsing currencies, and declining purchasing power have all eroded confidence in the global financial order. People see that their savings buy less every year. They see interest rates being manipulated. They see financial markets being artificially supported. And they see that the system depends on constant intervention to stay alive. When these pressures intensify, hard assets rise, not because investors are greedy, but because they are worried. A ratio collapse also signals that inflation and currency devaluation fears are becoming widespread. When people believe their currency may weaken, they move toward metals. Gold rising signals fear of inflation, but silver outperforming gold signals fear of something bigger, a loss of faith in the currency system itself. Silver is a metal for moments when people feel the financial ground beneath them is unstable. The ratio falling this low suggests that such fear is rapidly spreading. At the institutional level, a collapsing ratio indicates that big players, governments, hedge funds, asset managers, are repositioning. They are bracing for volatility. They are preparing for events that could shake markets, possible recessions, geopolitical conflicts, banking failures, policy changes, or currency transitions. These institutions do not gamble. When they move into metals aggressively, it means they expect turbulence ahead. Silver's rapid rise shows they are not merely hedging, they are preparing for deep structural shifts. A low ratio also points to a tightening of liquidity in the financial system. When liquidity shrinks, risk assets suffer and investors flee to safety. But when they flee specifically into silver, it reveals that they expect prolonged uncertainty. This kind of move usually precedes tightening credit conditions, reduced lending, slower growth, or economic contractions. Silver's surge is like a barometer reading high pressure, signifying that stress is building and the atmosphere is shifting. Furthermore, a collapsing ratio often appears before or during financial disruptions because silver is more sensitive to systemic stress than gold. Gold represents stability. Silver represents sensitivity. When silver reacts sharply, it reflects imbalances more quickly and more violently. The ratio falling toward 15, one suggests that these imbalances are no longer hidden. They're breaking through the surface. Finally, such a collapse is a warning that markets may be approaching a turning point. When ratios move to extremes, they rarely stay there. They usually lead to revaluations, resets, corrections, or new financial norms. A 15%, one ratio is shouting that the old system is cracking and a new phase is emerging. The market is sending a message. Something big is coming. And those who understand the significance of this ratio will be better prepared than those who ignore it. A ratio collapsing to 15%, one is not just a price signal. It is a sign that 2025 could become one of the most transformative years in precious metals history. When markets behave in ways that break all previous patterns, it means the world is entering a period where old rules no longer apply. A gold-silver ratio this extreme indicates that silver is no longer being valued under normal market conditions. It is being repriced by global forces that cannot be controlled: supply shortages, exploding industrial demand, declining inventories, currency instability, and a widespread loss of confidence in the financial system. These forces do not fade overnight. They build, intensify, and eventually create the kind of revaluation that changes the entire landscape of wealth and investment. Most people underestimate what a revaluation truly means. It is more than a price rise. It is a change in how the world perceives value itself. A ratio at 15, one means the market is repositioning silver closer to its historical and geological relationship with gold. For centuries, the natural ratio was believed to be between 10-1 and 16% based on how much of each metal exists in the Earth's crust. When modern markets push that ratio to 61-71, or even 120-1, it was artificially inflated by financial manipulation, paper trading, and lack of awareness about silver's industrial importance. Now that the ratio is collapsing back toward natural levels, it signals a massive adjustment, a correction of decades of mispricing. Such revaluations happen rarely. Once in a generation, sometimes once in a century. When they occur, they create opportunities of extraordinary scale. Those who understand the significance early can position themselves before the rest of the world wakes up. Those who ignore it often look back years later, realizing they missed something historic. A market shift of this size is not something that can be stopped by central banks, governments, or financial institutions. It is the culmination of natural economic forces pushing the market toward equilibrium. The year 2025 sits at the heart of this shift because the pressures driving the revaluation are accelerating. Industrial consumption is rising at its fastest pace in history. Supply is falling or stagnating despite higher prices. Inventories are being drained. Mining companies are warning of declining output. Technological advancements our increasing dependency on silver, all these forces point toward a future where silver is no longer a cheap metal. It becomes a strategic metal, a critical resource, and a store of value with far greater global significance. In 2025, this convergence could reach a breaking point. Once the market fully recognizes how scarce silver has become and how essential it is to the modern world, the revaluation may happen rapidly. Prices that once seemed impossible could suddenly become normal. The ratio tightening to 15:1 is the early indicator of this shift. It means the market is no longer waiting for supply and demand to balance naturally. It is forcing the balance by revaluing silver aggressively. This type of move also influences psychology. When people see silver outperforming everything else, they begin to pay attention. They see headlines, ratios, shortages, rising premiums, and industrial demand. Interest grows, fear grows, curiosity grows. Eventually, participation grows. As more investors enter the market, they drive prices higher, accelerating the revaluation even more. This process feeds on itself until the market reaches a new reality. 2025 could therefore become the year silver establishes its true value. Not the manipulated value, not the underestimated value, but the real value that reflects scarcity, necessity, and financial relevance. When a ratio reaches 15:1, the message is unmistakable. The world is moving into a new phase, and silver is stepping into a role it has not held in modern times. Those who recognize the signs will position themselves for this historic shift, while those who ignore it may only understand it once the revaluation is complete.